Hello students and welcome to the lecture. So students, in this lecture, basically we are going to talk about all about the Basel norms. Okay. This is going to be a lecture. In this, we will talk about the Basel III norms, Basel III Accord. What does Basel III is all about? What are the objectives, aims of the Basel III measures? Three pillars of Basel III norms, major features of Basel III, important facts related to the Basel norms, brief on the Tier 1 and Tier 2 capital, minus Tier 2 capital, then important notes, and at last we will see the summary of all of these things. But before starting them, there is a small disclaimer that we are required to understand first. So a disclaimer is like, the images used in our slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, please contact us at sathee@iitk.ac.in and we shall remove the images. So, first is Basel III norms. The Basel III committee, or you can say the Basel committee exactly, is the primary global standard setter for the prudential regulation of banks, provides a forum for cooperation on banking supervisory matters. It means that prudential regulations, the regulations that are useful for the banks to assess the risk they could have in the coming future. It is mandate to strengthen the regulation, supervision, and practices of banks worldwide with the purpose of enhancing the financial stability. Eric Tiden, he is the governor of Sveriges Risk Bank Sweden, and he is also the chairman of the Basel Committee. The Bank for International Settlement, BIS, established on date of 17th May 1930, is the world's oldest international financial organization. The BIS has 60 member central banks representing countries from around the world. Like you can say 60 countries are members of this particular organization, and these 60 countries central banks are actually the representative of those countries in this particular organization. Now, Basel III Accords or Basel III norms. Basel III or Basel III released in December 2010. Okay. This date is important because it could be asked in which year or in which month the Basel III got released. So Basel III got released in December 2010. Is the third in the series of Basel Accords. Okay, it means Basel first, Basel second, and then the third Basel III. These accords deal with the risk management aspects for the banking sector. As I have told you, these were for prudential norms. Prudential norms means careful norm, which means even before the event happens, the risk management expert must be prepared. According to the Basel Committee on Banking Supervision, Basel III is a comprehensive set of reform measures developed by the Basel Committee on Banking Supervision to strengthen the regulation, supervision, and the risk management. Three things: regulation, supervision, and risk management of the banking sector. Got it? Now, what are the objectives and aims of the Basel III measures? Basel III measures aims to, first, improve the banking sector's ability to absorb shocks arising from financial and economic stress, whatever the source. Okay. Second, improve risk management and governance. Third, strengthen the bank's transparency and disclosures. So these are the aims of Basel III as in prudential manner. Now, three pillars of Basel III norms. These are important. Pillar 1, minimum regulatory capital requirements based on the risk-weighted assets. Maintaining capital calculated through credit, market, and operational risk areas is this mainly that capital which could absorb the risk. Okay, it means Suppose if any type of risk would occur in the nearby future, then the bank must have the sufficient capital to absorb that particular risk. Second pillar, supervisory review process. Regulating tools and frameworks for dealing with the peripheral outer risk that banks face. Okay. Third pillar is market discipline. Increasing the disclosures that the banks must provide to increase the transparency of bank. It means that the stakeholders of the banks who are in the market must be aware about the real condition of the bank, so that the bank must disclose its current condition through various means. Now, major features of Basel III. Better capital quality. First, it is one of the key elements of Basel III is the introduction of much stricter definition of capital, which means capital with the higher loss absorbing capacity that could absorb the high amount of loss. This in turn will mean that banks will be stronger, allowing them to better withstand periods of stress. Second, capital conservation buffer. Another key feature of Basel III is that now banks will be required to hold a capital conservation buffer of 2.5% of RWAs. This means risk-weighted assets. CCB aims to conserve the capital of banks by making a buffer reserved for crisis situation. The aim of asking to build conservation buffer is to ensure that the banks maintain a cushion of capital that could be used to absorb losses during periods of financial and economic stress. Counter-cyclical buffer. The counter-cyclical buffer has been introduced with the objective to increase the capital requirements in good times and decrease the same in bad times. The buffer will slow banking activity when it overheats and will encourage lending when times are tough. Therefore, in bad times, the buffer range will be from 0% to 2.5% of risk-weighted assets, consisting of common equity shares or other fully loss-absorbing capitals. Thereafter, minimum common equity and Tier 1 capital requirements. The minimum requirement for common equity, the highest form of loss-absorbing capital, has been minimum common equity, the highest form of loss-absorbing capital, raised from Basel III from 2% to 4.5% of total risk-weighted assets. The overall Tier 1 capital requirements consisting of not only common equity, but also other qualifying financial institutions, which also increase from the current minimum of 4% to 6%. Although the minimum total capital requirement will remain at the current 8% level. Leverage ratio. Our leverage ratio is the relative amount of capital to total asset, not risk-weighted. This aims to put a cap on swelling of leverage in the banking sector on a global basis. 3% leverage ratio of Tier 1 will be tested before a mandatory leverage ratio is introduced in January 2008. Liquidity ratios. Under Basel III, a framework for liquidity risk management will be created. Our new liquidity coverage ratio and net stable funding ratio are to be introduced in 2015 and 2018 respectively. Important fact related to the Basel norms. First, minimum ratio of total capital to risk-weighted assets must be 10.50%. Minimum ratio of common equity to risk-weighted asset must be 4.50% to 7%. Tier 1 capital to risk-weighted asset must be 6%. Core Tier 1 capital to risk-weighted assets must be 5%. Capital conservation buffers to risk-weighted asset must be 2.50%. Leverage ratio 3%. Counter-cyclic buffer 0 to 2.50%. Then the brief on Tier 1 and Tier 2 capital. Tier 1 capitals, paid-up capital, statutory reserve, other disclosed free reserve, capital reserves which represent surplus arising out of sale proceeds of the assets, investment fluctuation reserves, innovative perpetual debt instruments, perpetual non-cumulative preference shares. Minus equity investment in subsidiaries, intangible asset, losses occurred in current period plus past carried forward. Tier 2 capital, undisclosed reserves and cumulative perpetual preference shares, revaluation reserves, general provision and loss reverses hybrid debt capital instruments such as bond, long-term unsecured loans debt capital instruments. Now the important notes. The Reserve Bank of India has extended the timeline for full implementation of Basel III capital regulations by a year to March 31, 2019. This breather comes in the wake of industry-wide concerns about the potential stresses of the implementations of regulation on the asset quality and consequential impact on the performance and profitability of banks. So here we have finished the topic. Now it's part for the summary discussion. We have talked about the Basel Committee overview, their purpose, their chairman, their establishment, Basel III overview, release date, their goals, key components of Basel III, means pillars like pillar 1, pillar 2, pillar 3, capital quality, capital buffers, capital conservation buffer, counter-cyclic buffer. Minimum capital requirements like common equity, overall tier 1 capital, total capital requirements, leverage ratio, liquidity coverage ratio, non-net stable funding ratio, minimum ratio for Basel III like total capital to RWAs, common equity to RWAs, tier 1 capital to RWAs, core tier 1 capital to RWAs, capital conservation buffer, leverage ratio, counter-cyclic buffer. Tier 1 capital components including paid-up capital, statutory reserve, disclosed reserves, etc. What are excluded we have seen. Implementation timeline we have seen. Notes for studies we have seen. Okay, so with this we have finished this lecture. It is requested to all of you kindly revise the facts and figures that all we have discussed in this lecture and keep yourself ready for the next lecture. With this note, let's end this lecture and thank you.